Okay, I guess it's about time for me to start, folks. So, welcome to another London Open. It's Friday, and we've actually had a very exciting week. We've had data, we've had price action, things that any trader would want to have or would want to would want to have in the market. All right. So, what do we face at this point? Let's take a bit of a review of the different asset classes. When we look at our stock indices, we had a poor day in Japan, surprisingly, but we were up in U.S. equities yesterday. We had European equities up yesterday as well. Asia was a bit of a mix. And oh, sorry, that was my phone. Okay, and let's see what else is happening elsewhere. Commodities, we have energy prices bouncing. Uh, Gold, by the way, has seen new historic highs. Um, so there's a lot to think about as far as the markets are concerned. There's a lot of things to discuss. Let's look at the calendar. What happened yesterday? Well, we had inflation numbers from the US yesterday, and they came out short of the expectations, short of consensus forecasts. So inflation was softer. And what's the implication of softer inflation numbers? Normally, when you hear that inflation numbers are lower than expected, or are trending lower, or is well, most people would call it softer. If you hear those kinds of terms, it's telling you that okay, prices are not rising as much. And if prices are not rising as much, it tells you that central bank policies have some leeway. If a central bank sees that the economy is slowing and prices are dropping, then they have leeway to say, okay, looks like we can potentially lower interest rates, try to revive the economy a bit, and as a result of those softer numbers from U.S. inflation yesterday, we saw the U.S. dollar dropping across the board. Let me just drag and show you a chart of that. So, yeah. Here's yesterday's drop for the dollar, and here's the Asian session follow through. Although if you look at the dollar index now, we seem to have that bounce already from the earlier lows in Asia. Okay, something to discuss later. Now, what else should we be thinking of? Calendar-wise, not much from yesterday besides the inflation data. For today, okay, we've actually had strong GDP numbers from the UK. Okay, they were flat before, and now they have an 0.5% growth month on month. So that's helping your British pound bounce back up a bit. Later, we've got producer prices. I think what's critical though would be your consumer sentiment numbers. Okay, why do we say that consumer sentiment numbers are critical for the US? Well, let's put it this way. The US is a consumer-driven economy. 70% of their GDP is about people buying stuff. And if consumers don't feel good about their situation, if consumers think that I'm not sure if I still have my job. So if I won't have a job next month, then how can I pay for stuff? If consumers are thinking that way, then that would be bad for an economy that is 70% driven by consumer consumption. So we've got consumer sentiment data later. These are preliminary numbers. And how important are they? Well, there's this fear in me that these numbers will be short of the previous numbers, potentially below the consensus forecast, given that the surveys for these sentiment numbers was done at the time when Donald Trump was starting to roll out his economic agenda, his tariffs agenda. He started talking about tariffs during this time. He started talking, or rather, his hatchetman, Elon Musk, started firing a lot of government workers during this time. So this could be a bad number, and that could be, well, let's put it this way, that could be an excuse for dollar to see weakness later on. Other things to consider, by the way, let me get back to the consumer, the CPI data, because I forgot to mention it. So CPI did turn out weaker than expected yesterday. However, I would point out, guys, that we are facing the potential impact of the tariffs. Although, again, Trump has been so crazy, so unpredictable, that I'm not really sure what his plans are now. So, because they delayed the implementation of the tariffs for most countries except for China. But let me just say this again. Tariffs are a form of tax. Tariffs are inflationary. If you put a tariff on an import, that means that prices of goods, when you go to your groceries, when you go to the department stores, when you go to your Walmarts, your Costco's, tariffs will have the impact of raising prices on you. So I just wanted to point that out. Although the immediate impact of your weaker numbers was for the dollar to strengthen, or rather, sorry, was for the dollar to weaken because of the idea that the Fed might decide to cut rates. Given that inflation is dropping, you could have a spike in inflation, say in 2-3 months time, or whenever Trump actually does push through with his tariffs with the other countries. But remember, we are going to have a tariff, or there is a tariff already for China. They've doubled the tariff for Chinese goods. It's like 100% now. So I'm not sure of the numbers on this, but I'm pretty sure that a lot of the things that you see in Walmart, that you see in Costco, is made in China. And if there's 100% tariff on this, that, simple math would tell me that if you bought say a toy that used to cost $50 and it's made in China, a tariff would make it $100. So imagine the kind of inflationary impact that would have for a lot of the common products that people buy. In fact, people were saying iPhones at $3,500 for the basic model. All right, so let's move to charts. Let's see what is there for us to trade at this point. So general overview, as we said, we had a dollar sell-off yesterday. We have these spikes in your euro cable, gold prices seeing new historic highs, what can we do at this point? Of course, this is the London session, and this is me. And normally, okay, you know what? A lot of traders would like to trade as much as possible, whatever they see. But for me, as a trader, your objective has to be making money. You're not there to trade just for the sake of trading. You're there to try to make some money out of the market. So why am I saying this? I'm saying this because that's my explanation on why I normally would like to trade the euro. Why do I like trading the euro? Because euro has a very tight spread. EUR/USD is the most widely traded currency pair. And you've got a lot of traders actually trading this instrument, trading EUR/USD right around the open of the London market. Now, what do we have in our euro chart? So you see this big, let me switch charts there. So you see this big rally in your euro from, well, over the course of, well, from yesterday, essentially. Okay, so you see that big rally in euro yesterday. If I were to look at our euro, very big, let's start big picture first. If we look at our euro big picture, let me go to the weekly charts. And what does this show you? Weekly chart. We are in the process of taking out that key resistance level around the 1240, 1250 area on the weekly level. So this is pretty significant. If we close the week above that 1250 area, I think that says there's been a change in market structure. Okay, close the week above it, and we'll be talking about 2022 price levels for euro. Okay, it's now 2025. So that's how far back you'd have to go in order to see chart prices, if there is such a close on a weekly scale. All right, so weekly scale, it looks like we are going to get that big breakout. If we do close above 1250, that opens us to euro ranging perhaps from your 1200 area towards the 1600 level. So we're talking about this area here around 1600, this area here. So essentially we're looking at this period in time. That's about December 2022. That consolidation from December 2022 would be our guide going forward if we have the weekly close above 1250. Now, I mentioned weekly close. By the way, look at your candles in the weekly candles in euro. You have the big spike from March, and then this week's spike. You've actually had a flag pattern. Yeah, you want? Yeah, this is the first time I've realized that there is a flag pattern in euro earlier, because I don't normally look at the weekly charts. I am an intraday trader. I don't have any business looking at the weekly charts. But look at this flag pattern, and there's still some room until that flag pattern's price target is hit. By the way, the way you look at what's the target of your flag pattern would be, you look at the size of this pole, essentially this candle, and then you just project it here. That's the target of that pattern, and it looks like it's going to hit around 1600 for that flag pattern to be fully completed. Okay, so flag pattern in the weekly scale. If I go dailies, we have this consolidation breakout. We consolidated earlier in the week, and then breakout from yesterday following those weak inflation numbers in the US. Indicator wise, things look bullish for me. I've got that MACDs opening up, I've got that stochastic looking to re-enter overbought areas. And again, if you look at the charts, nothing in those daily candles there's nothing there that tells me that it's going to falter, that it's going to stop. It's taken out the resistances already from the daily level. Okay, this price area here, 1200, we've taken that out. So we are, we're at the stage where we're trying to figure out whether a long-term breakout is happening and it's going to continue and it's really valid. All right, let me go intraday. And here's the thing, folks. This is Friday. So this is what makes this day very interesting. Fridays normally are pullback days. People who made money earlier in the week would be closing their trades, but at the same time they're looking at the chart and they're seeing, no, this is a weekly scale change in market structure. By the way, we have the open of the market already. And what do I have? Very interesting again. Let me drag some Fibonacci's. This is our rally. Look at this. So I have a dragonfly doji in the previous hourly candle. That really makes me very bullish about this thing. And I have stochastics, MACDs crossing lower, which is really telling me that, hey, that's overbought. Maybe this is gonna pull back some more. If we were coming from 38.2 Fib, coming from that 1202 area, I would happily just jump long at this point. But I don't have that. What I have is something that tells me this could move up some more. Okay, you have this candle here, that dragonfly doji. That dragonfly doji tells me this chart should be looking at retesting the highs that it saw in the Sydney session. So do I buy this now? Remember, this is the open of London market. And why do we want to trade during the open of London market? Because liquidity comes in. So yeah, because liquidity comes in, this is moving, folks. I'm gonna jump in at this point. Euro long. And let's do some trade management. Let me put a stop loss. Ideally, the stop loss should be below the low of your dragonfly doji. That's quite a big stop loss. Target. Well, okay, I'm not gonna use your usual risk reward ratios for one reason, because we are using a prop evaluation account. And I have rules to follow. And rules to follow for me means that I cannot have a big profit. I have a consistency rule. So I cannot have a profit of more than $1,000 given the challenge target of $5,000 and a consistency rule of 20%. So I have to limit my upside. This is not how you should be doing it. I mean, you should when you're trading, you should really be looking for a nice risk-reward ratio. But because of that rule, I can't really follow it. A solution for me would have been, okay, Mark, you should have used a lower lot size. Yeah, that works. I should have used a lower lot size, but I'm greedy enough and I'm confident enough about my direction that, okay, I'm going to violate a bit that risk-reward rule which a lot of traders follow. So let me keep my stop loss below the dragonfly doji. Okay, since we're using C-Trader, hello Spotware, hello Eleni, let us try to maximize the features of the platform. So let's use what we call advanced take profit tools. And let's put some, let's split our trade, put some take profits at different levels. Let's split it into 3 levels. And let me apply that. Let me also apply a stop loss break even. So this is one advantage of using C-Trader, folks. You have a feature that's called an advanced stop loss, which basically moves your stop loss to break even when a certain number of pips has been hit already. And then you can also place multiple take profit targets. Voila. So we've inputted things, and you can see in your chart that you've got those. Okay, looks like we have. Okay, so there we go. So what's the target of our upside here, folks? Well, at the very least, you should be looking for prices to push towards the earlier Asian session highs around the 113 area. Okay, 1.13. Okay, so this trade is ongoing. Let's all right, looks like our first partial profit has been taken out already. Hoping for the next ones. Okay, so there we go. One lot has been taken out of the market. We are hoping that this really moves all the way towards 1300, although I'll be taking out the market before that. Now, one thing, folks, you can have your okay, so let me skip Euro. We're already in it. Let's take a look at other charts, see if there are other stuff that we can be doing. Although honestly, part of me is thinking, yeah, just look at the charts. All right, do we skip Euro or what? I'm getting excited. Can we? Okay, folks, you just have to forgive me. I just want to stare at this Euro chart at this point. Really looks like we have momentum here, guys. So yeah, our trade's running, and actually, you know what? I'm realizing something. If we use multiple take profit levels, does that violate your consistency rule? That's actually something that I should probably be asking the prop firm that we're using, because technically, if all my TPs will get hit, I'd be exceeding the I'll be exceeding that consistency rule. And you know what? I don't know what the answer to that question is. So I guess it's better for me to just not exceed the consistency rules. Close one of the trades now. Yeah, okay, I'll just close everything at this point, folks, because I don't want to violate the consistency rule. Okay, so guys, I closed everything. My reasoning is, if I waited for the other TP levels to get hit, then I would be exceeding that 1000 limit. So I got out of the market. If you're long, I would say hold on to those buys. Average daily range for Euro is at, let me check. add our ATR. Average daily range for euros about 144 pips. We have the lows today at 111.81. We have our high at 13.84. Okay, so we've actually exceeded your average daily range in euro. So, given that, what else can I do? Well, I can think of later on. Okay, not now. Now you continue to just hold on to your buys. But since we've exceeded average daily ranges, we will limit our expectations to merely a retest of the earlier highs at 1300. And actually the high is at let me see the number. 1384, yeah. So if we see 1384 later, what do we do? That's the big question, folks. Because if it's already New York session and I see 1384 and we start seeing candlesticks that look like this or this, okay, you see something like this at that price area and the time is already 1600 GMT, you have the potential for people who made money earlier to start saying, okay, let me get out of the market, let me take profit. And okay, so this could be a selling point later, but I would have limited expectations on just how long that sell would stay. Those will probably be intraday traders getting out of the market then. What about trying to catch the upside now? What about trying to buy this euro at this point? Timing wise, let me put it this way, folks. Not a very good price to buy already. The ideal entry was when we had that initial spike through the, okay, this was the ideal entry. Joining here now would give you a bad risk reward, which is what I actually did earlier, but as I explained, I did have to follow some consistency rule. Absent a consistency rule, then yeah, this is not a good trade at this point. I'd rather that you wait for gravestone dojis, shooting stars, or this is a shooting star, this is a gravestone doji. I'd rather that you wait for these types of charts to appear, or rather candles to appear, around 1380 before you jump short. And it would be best to do so when it's already close of Europe. Buying now at this price level, not a good idea given the risk reward. What if we see prices easing down at the end of this hour or during the course of the European session? If during the course of the rest of the European session we don't get anywhere near 1380, okay, then I would potentially look for buys again if I see prices coming from Fibonacci retracement 38.2. Again, though, it has to be with hammers or with dragonfly dojis, just as this one. Okay, that would be a nice combination. Hammer, dragonfly doji would be a good combination. Chasing the market now, again, not a good idea, given that you have a poor risk reward. Let me go to some other chart, folks. Let's take a look at gold. Okay, I don't really, to be honest, I don't really trade gold. Like I said, I just want to have safety, try to be consistent. I want to have liquidity. Gold's not that for me. So we will take a look at gold, but we're not going to be trading gold. Sorry. You know, a lot of traders, oh, doesn't look good. Let me open gold in another chart. You know, a lot of traders want to trade as much as possible. There's a lot of traders that look at really a lot of charts. There's a lot of traders that look at multiple charts, and they just tend to jump in on whatever instrument they see in front of them. But I'll tell you something, guys. If you were working for a bank, they're not going to allow you to trade whatever instrument that you see in front of you that you think is attractive. They're going to allow, a bank would assign you to a desk. A bank would tell you, okay, you'll be the dealer for euro, yen, all the yen crosses, or all the euro pairs. They're not going to tell you, you can trade euro, you can trade cable, you can trade gold, you can trade silver, you can trade Bitcoin. Why am I saying this? A common mistake of us retail traders is to just jump in whenever we see something attractive. I don't know, maybe it works for some people, but I think it's a bad idea for people to just jump in on everything that they see. I tend to think, try to get some degree of familiarization with the instrument that you're trading. Okay, I don't care whatever instrument that is. If you're trading the Hang Seng, trade the Hang Seng, but get to know what moves the Hang Seng. Get to know the cycle for Hang Seng trading. Okay, get to know who are the players for that particular instrument. Because if you just jump around because you see a triangle, you see a head and shoulder, you see a cup and handle, you see a wedge, and you're just jumping around from all these different instruments, I tend to think that that's folly. Although, okay, don't get me wrong, I believe in technical analysis. I believe that technical analysis is rooted on the three precepts being history repeats itself, prices discount everything, and prices move in trends. And supposedly, all those three precepts combined are the principles that, technical analysts and technical traders follow. And in theory, that should mean that a cup and handle in euro will work the same way as a cup and handle in gold, will work as the same way as a cup and handle in your Bitcoin. And to a degree, I accept the notion that chart patterns work, but as I said, I think that you also have to know the nuances behind the instrument that you trade. So I guess I'm defending why I don't trade other instruments, because I know a lot of people who just jump around. But that's my way of thinking about this. Now let's take a look at gold. So where's gold? Gold is at historical highs. You have that nice trend line in gold. In fact, I'm not going to use a pen. I'm going to use the platform's trend line figure, trend line tool. You have this nice trend line. Look at that. Very nice. Okay, very consistent. If I were one of those, because there are technical traders who actually give value to the degree of the angle of a chart. I don't really tend to think that way, given that that's a spatial matter. Because those angles of the chart will change depending on how the chart is plotted. So I'm not that kind of person, but look at that. 45 degrees. And if you know basic science, what does 45 degrees tell you in basic science? If you shoot a bullet and you want to get that bullet to reach its maximum range, you shoot it at a 45 degree angle. Now, I'm not saying that there's a relation to that in technical analysis, but it's just something interesting that this gold thing here has a 45-degree angle in its trend line. But what can we do in gold? New highs. So I guess we will now be saying that gold is well resisted at 30 to 20. Why has gold rallied over particularly? Okay, gold has rallied particularly the last month. Okay, ever since all the disruption in trade policies, in economic policies, gold has rallied because gold is the oldest safe haven asset. Okay, more than your Bitcoin, more than the Japanese yen, gold's been considered to be a store of value from time immemorial. So, what do we do in gold? We are bullish. Are we in a position to join the buy side? Well, let's put it this way. You are well resisted in gold. You have good resistance in gold at 3220. Working rate is 3200. I tend to think at this point that although we have an uptrend in gold, you're in the middle of what could potentially be the consolidation zone of gold over the next few weeks. So what I'm saying is, you're not at a good price to buy gold. If you find gold, let me just delete this. If you find gold prices, if you find gold prices around this area, if you find gold prices around this area, 3200, 3190, and you start seeing intraday charts again, I would always fall back to hammers, dojis, dragonfly dojis, gravestone dojis, shooting stars. I'd always fall back to those as the best entry signals if you're a candlestick trader. So if you find yourself with a combination of a good price in gold and you start seeing those hammers, those dragonfly doji, you start seeing those candles around 3190, then yeah, why not? You just try to play the range. Okay, the safest way of playing this range would be to pick the buy side. I don't think all the craziness in the world is going to subside anytime soon. So there should be plenty of excuse to go look for stronger gold prices. So try to look for these candles and just play that range. I don't see any reason why we will see new highs in gold anytime soon. We need more craziness in order for new highs to come in the coming week, in next week. So for now, guys, no immediate action, but start giving me those prices, and I look for a test of those levels for today. So no immediate buys. How about selling this? Well, we have had a good rally in gold since let me just zoom out. So we've had a good rally since Wednesday. This is hourly charts. So yeah, If there's a break, of this level, break of that 3190 area, then at that point we can consider taking the sell side. Alright, why is this so fat? If there's a break of the 3185 area, 3190, we can consider shorting it. Our target would be chart-wise this level here around your 3130s level. You can pull up some fibs. And what does that fib tell you? Ooh, looks like fib is telling me 3123 would be the nice pullback point for gold. So no immediate buys. Immediate risk is actually for a pullback to happen towards that 3123 region, towards 38.2 fib, towards this previous consolidation. Can we sell immediately? Again, no. Need to have bearish candles, a break of this, a close below 3185. Okay, that kind of candle would be an excuse for me to jump short. This would be your target. Buying, give me hammers here, and I'll say that this trend in the hourly chart will just continue on. Absent that, I'm not keen about doing anything in gold. New high, I just don't see the reason for a new high at this point. Not when Trump has paused his tariffs. Okay, not when we don't really hear anything new about what's going on. Okay, let me just think. Geopolitical wise, the only other catalyst that I think market has not really factored in is if the US goes crazy again and they decide to start doing something about Iran. Remember, Trump has been trying to get the Iranians to come to the table, talk with him directly. Okay, so this actually one potential angle that the market hasn't really factored in. What if the Ayatollah decides to sit down with Trump? Because Trump has been saying, look, Iran, come sit down with me at the table, talk with me directly. Let's make a deal out of the deal as far as Mr. Trump's concerned. They get something like that. And okay, that's not actually good for gold, but that's actually an excuse for gold to suddenly go down, because that kind of news is not something that's in the radar of people at this point, I think. Okay, only people who are into geopolitics would be are aware of this. So yeah, that could be a catalyst for a big pullback in gold. Upside, if Trump goes crazy and he decides to bomb Iran's nuclear facilities. If you monitor the Middle East, the news in the Middle East, we know that a lot of those stealth bombers are now in Diego Garcia. They've been bombing the Houthis. The Houthis are proxies of Iran, and Iran has actually been deploying more radars to try to detect those stealth bombers if they're closing in on its territory. So yeah, you hear something about bombings in Iran, this is going to push your gold up very crazy. But like I said, I doubt that that's going to happen. I mean, okay, I'm not completely saying that that's not going to happen, but I don't think I think it's unlikely to happen. The more I'd actually give more credence to the idea that Iran will decide to deal with Trump, and if they do, that will be an excuse for you not just to look for an intraday pullback in gold, but that kind of news. Trump and Iran talking peace would have me thinking daily scale pullback in your gold prices. Would have me thinking back to below 3,000. All right, folks, so it's the end of the week. I hope you've had a nice week trading, and please join us on Monday's London session coverage. So guys, thank you for attending. And oh, by the way, we are going to have a face-to-face workshop on trading. I'll leave the details below in the comment section of the Facebook and the YouTube channels. Okay? So guys, again, thank you for joining me.